Welcome to the HC Commodities Podcast, a podcast dedicated to the commodities sector and the people within it. I'm your host, Paul Chapman. This podcast is produced by HC Group, a global search firm dedicated to the commodities sector. Welcome back to part 2 of our episode with Nick Kumleben, the Energy and Commodities Director at Greenmantle, the geopolitical and macro advisory firm that weaves in historical context to help organisations understand the current markets and opportunities within them. In part 2 today, we're taking the discussion on into metals and critical minerals, into government security and the impact on traders and the trading opportunity out there. As always, you can really support the show by leaving us a positive review on the platform you're listening on, and I hope you enjoy the episode. Well, Nick, welcome back to the show.
Thank you, Paul.
We've covered the overall signal and noise of what's going on in the Trump administration and how that is starting to affect the commodities world. We've talked about energy in particular and some of the challenges there and what it means in lower oil prices, challenges around gas, particularly US gas exports, and then power. So this key theme, the signal, correct me if I'm wrong, is lower energy prices. How is that going to be affected by tariffs? Again, are we seeing sort of an internal inconsistency there between those two policies?
Not necessarily, Paul, and energy is one of the few areas that's been fully exempted from the tariffs. If we look at what's been exempted, energy, critical minerals, copper, chips, and pharma. Now, the last three, copper, chips, and pharma, are under ongoing Section 232 investigations. So the exemption is in light of an ongoing investigation that will likely result in tariffs on these products. But for energy and critical minerals, they've been exempted because of the administration's focus on, in energy terms, lower prices, and on critical minerals in reshoring supply. We've heard nothing yet that implies that they're likely to see universal tariffs on these flows, and that reflects the administration's prioritization of US energy security and mineral security.
That's all true, but that sort of ignores the valves, the steel, all of the pieces that go into that supply chain to produce the energy.
Right, and this is where these signals push in countervailing directions. I think we saw this quite clearly in E&P executive comments the Dow's Fed in the most recent energy survey, where we saw a very low estimate of the costs of regulatory compliance. And we saw executives saying, actually, my valves come from Canada. My steel's going to get a lot more expensive given the steel tariffs. I think if you look at the challenges the energy industry has faced in finding labor over the last couple of years, the administration's migration policy certainly doesn't help there in tightening the labor markets. So you have this 1-2 punch for energy producers in which prices are structurally lower. That's clearly a key focus of the administrations. They're likely to stay low given the fears to global growth and the energy diplomacy ongoing in oil markets. And then your costs are increasing. So you have margin pressure coming and going. The minerals picture is quite different, and we can come on to that.
Yeah. Just staying on energy, there's a couple of other pieces. One is this assumes no retaliatory tariffs or other economic blocks put in place, right? And secondly, particularly for the offshore sector, they're most often dealing in other jurisdictions, lots of drilling going on in Central and South America, North Sea, Asia. To do that, they are often drawing on crews from different parts of the world. There's a lot of barriers and uncertainty that go up there as well, right? I mean, this picture is we can't only look at it from the US lens in a world where they're triggering a trade war. You can have serious unintended knock-on consequences that again come back to the fact that, yes, the goal is lower lower energy prices, but that's going to have a profound impact on ongoing business operations and costs for these organizations, which would be inflationary.
Right. Yes, that's fair to say, Paul. And I think the difficulty for the firms operating internationally is that you have the United States no longer seen as a reliable partner in a way that really hasn't been the case since the fall of the Cold War. You've had the entire world open to commercialization and to investment. Of course, there are country-specific issues and country risk premia, but there hasn't really been a country risk premia on the United States that affects countries doing business abroad. Now that exists in a very concrete way, and you also have this input inflation across the board. So it really is a challenge for a lot of these operators, and one that doesn't go away if policy shifts back to a low tariff environment. I mean, we need only look at Canada as a case study of that. Sure, if you have a divided Congress or a Democrat in the White House, tariffs will go away and Canadians might start coming back to the United States on holiday and buying American liquor and other consumer goods again. But that perception of political risk, once it exists, it doesn't go away quickly.
Yeah, I mean, I was going to ask that, and there's so much to cover. Like, we had, obviously, Prime Minister Mark Carney's speech. I think over the weekend we had the Premier of Singapore, both sort of essentially saying that, this is a new world order. We're in a very different regime, and it seems like, because that's the question, right? Let's play the scenario out where tariffs were all just a big sort of, maximalist negotiation position, game theory. The plan was never actually to enact them, but just negotiate bilaterally trade deals around the world. You still ultimately introduced a risk premium there that's going to have a profound impact on the world and the US economy.
Yes, that's exactly right. And if we look at world leaders' comments, and Prime Minister Ishiba in Japan made the point, Japan's America's biggest investment partner. It's a crucial ally of the United States, key source of foreign investment into the US. From that perspective, I think if you, as a trading partner of the United States who's played by the rules, whatever rules that are set there, everything from doing final assembly of cars in the United States to significant investment in the US, you can't be sure that this is the final step on the journey. And certainly for a lot of the key players, the US has talked about increasing tariffs from here, not decreasing them. We need only look at China as an example of that. The difficulty of escalate to de-escalate, as Treasury Secretary Bessent puts it, is that you can never reach a stable equilibrium, because in a world where you're escalating and de-escalating, there's no final point of tariffs at which everyone goes home happy. The deals are always open to renegotiation, and the art of the deal might be a compelling real estate negotiation strategy. But from the perspective of trying to create the certainty that investors and American companies need, it's clearly not working.
Yeah, just staying on crude. And so there are these inflationary forces, this countervailing sort of narrative here, where we might see lower prices from one angle, but overall costs are going up, and that could put E&P in a very difficult situation. Again, the narrative has been a rapprochement with Russia. If that doesn't play out, we've already had talk of extending secondary tariffs on Russian crude. How real is that? What's the view there, and what impact would that have?
The interesting thing about these secondary tariffs on Russian crude, right, is like all of the other actions the Biden administration and Trump administration have taken on Russia since invaded Ukraine, they don't actually remove a barrel from the market. And the US government has come up with all these creative ways, from the price caps to banning American imports, to sanctioning key financial institutions, to sanctioning tankers, to now this secondary tariff idea, which goes to show the US has been willing to do absolutely everything except reduce Russian supply. in a world where secondary tariffs are put on goods of buyers of Russian crude, you could certainly see Russian supply decline, but you could also just see a significant discount and more disguised sales. It's worth thinking though just about that specific comment that Trump made. It was made in a somewhat offhand way. We would really read into that as noise.
Yeah.
The scale of disruption it would create in global oil markets, especially at a time when the US is actively negotiating with India, the key buyer of Russian oil, along with China, to reduce trade barriers and open up Indian markets to trade with the United States. Trump making an offhand comment about secondary sanctions on buyers of secondary tariffs, I should say, on buyers of Russian oil at the end of an interview covering multiple topics. That seems like noise rather than signal. Secondary tariffs on Venezuela, sure, but Russia is a different beast.
The signal's definitely pro-Russia, I guess, would be the sentiment there. And we'll come on to trading strategies, because all these distortions do create a lot of opportunities, right? Sending your stuff from China to a lower tariff jurisdiction and then anyway, but we'll get there. Okay, so let's talk copper and then let's talk cars. Again, with this sort of rubric of, an intent on lower prices, but actually quite inflationary underpinning policies. Copper is key. It's obviously key to the energy transition. It's also fair to say that there's a significant rebuild required of the American grid infrastructure, which, as I understand it, is kind of coming up to that 50-year mark where it does need replacing. So a lot of copper demand out there, quite a positive story. Where is copper right now in tariffs, and what is the outlook?
Yeah, so to give you the headline, Paul, there are Section 232 investigations on copper. They've been running since late February, and they've got a 270-day deadline. So later this year, we'll have an answer. US copper prices rallied on the announcement of tariffs, and a significant spread opened up between US and European prices based on the market pricing in a base case of tariff implementation. The logic there is really that you need to reshore a lot of this production. I think it's important to mention that based on our understanding of the USMCA rules of origin question, a lot of the copper produced in Mexico and Canada would still qualify under USMCA and thus not face significant tariffs. There's an element of friendshoring there. But what this does, right, is provide a price signal to US and North American producers and processors of copper that if you're sitting on scrap, now's the time to process it. If you've got a mine coming online, your economics are juiced. Although, as we've discussed, their policy elsewhere acts against that. I mean, copper's pretty much flat on the year despite a run up in the early part of the year, because it's been down significantly in the last week, 15-16% on global growth risks. And a world where you're hitting the Chinese economy hard with tariffs is not one in which copper prices should be going up, even if you're putting a premium on the US market through tariffs. So again, it's a story in which the signal of one policy action contradicts the signal of another.
Yeah, and again, this is all assuming that there isn't retaliatory action specifically around exporting copper, and indeed we'll come onto the critical minerals as well, right? I mean, the power of China, particularly in this narrative, is that they could cause enormous disruption, as we're sort of already starting to see them embark on some of the critical minerals, by responding with export controls.
Right, and China knows that in the context of US-China economic confrontation, the one area in which China really has asymmetric dominance is critical minerals. The US has it in energy, in chips, in software and AI, and in various and probably in a military perspective too. China has critical minerals, and that is their key card to play in this form of economic warfare. We've seen over the last couple of years with gallium, germanium, and now we're seeing in rare earths, which is a hammer that some in the US government have been waiting have been waiting to drop on their heads for a long time. It really is the preferred method of retaliation for the Chinese government. And the government spent the last few decades through subsidies, through state-owned companies, and through investment abroad, securing its supply chain precisely in order to play this card in the scenario of a showdown with the United States. Those chickens are coming home to roost, and I think we'll see that in supply chains going forward.
Isn't this all, and you throw in automakers here, right? Tariffs on steel and aluminum, but many of these cars, even if they're built in the US, components are crossing borders multiple times. Isn't this all just actually the signal is inflation? Across the board, you're creating tariffs and then the resultant economic trade wars, the uncertainty you're creating, the disruption to supply chains. Is this not all, irrespective of what's going on in deregulation, the focus on lower energy prices, that actually when you're in the boardrooms of whether it's an E&P company or whomever it is, an OEM, 20% inflation? I mean, is that not the logical conclusion of all of these pieces we're weaving together?
I think that is right, Paul, and it leads us to a very different macro backdrop with implications for these companies than we've had really for the past 30 years. We've had this, with the exception of a spike in 2022, benign, low inflation, low rates by historical standards environment. And that's now turning on its head, largely driven by shifts in trade policy, although to some extent also driven by demographics. And the autos are a fantastic example, because not only do you have these technological shifts providing a backdrop of uncertainty in terms of whether your capex should go to internal combustion engines, hybrids, EVs, whether you should just be investing in EV production themselves or looking to lock up supply as well. You've now also got tariffs on car parts, and these car parts, at least in the USMCA context, may cross a border 7 or 8 times before being put into the final car itself. So how you can reorient your supply chains to such an immense degree, knowing that in 3.5, 4 years, all these tariffs may go away and you're left with factory assets that aren't competitive relative to your prior setup. I mean, it's almost impossible to navigate. And you're right that the clear through line here is likely higher inflation, although we won't know for a while.
Yeah, this is like Boeing, right? All of those TV screens, all the stuff that Boeing doesn't make is imported from Korea and Taiwan. And it's sort of, I guess, going back to that historical analogy, it seems, and I think Neil Ferguson has said this a couple of times, there's also this very worrying analogy with the 1930s, right? Reactionary tariffs, retrenchment from free trade, rise of nationalism. It's pretty bleak if you play some of this out, right?
Exactly right. And I think, Smoot-Hawley is almost a more depressing analogy than the McKinley one that I proposed earlier, because of the strategic implications and the way in which tariffs and economic decoupling worsened existing political differences. I think the question today is does this embolden or does this on net hurt America's adversaries? And frankly, from the perspective of China, in a world where you're decoupling from the US much faster than you expected, and you're functionally at economic war with America, the costs of action over Taiwan become significantly lower. I think we saw that to an extent with Russia, whereby as US policy became harsher, the costs of breaking the relationship fully became lower. It's part of the problem with sanctions. The deterrence declines as soon as you've imposed them, because your economic relationship gets less importance. And as the US decouples from the rest of the world economically, if Trump is successful, its leverage over other countries from a diplomatic perspective declines along with that interdependence.
Yeah, this is US aid. We've already seen in Myanmar, they would normally have been a key player. China's stepped in. You've seen China announcing, I think an old Ford plant in Brazil is now going to become a BYD factory, right? I mean, yes, your economic your soft power is declined significantly as well. All of which lowers some of the stakes to actually this transferring from economic warfare into real warfare. Not to scare everyone, but okay, let's go on to metals. Okay, so yeah, the administration's signal would seem to be critical mineral supply chains are key, and they're exempted from tariffs. There seems to be the message has been heard loud and clear by both parties in Washington about how far behind they are in the new economy and the materials and the minerals and the processing that's required to deliver that. Where do we sit there?
I think we're seeing two things. One is the government is pulling every lever it can to incentivize the growth of American-led supply chains in metals, be it a minerals for security deal with Ukraine, despite the lack of any real indication that Ukraine has economically recoverable, valuable critical minerals. The US is proposing a share of Ukraine's minerals in exchange for security cooperation. It looks like we're quite close to a similar deal with the Democratic Republic of the Congo. The US Development Finance Corporation is likely to aggressively invest in mineral production processing both in the US and abroad. And that's obviously great if you're a consumer of these metals in the US as, say, an auto or defense OEM. It's great if you're a miner who can access this cheap public capital and benefit from US security guarantees. But we're also seeing the limitations on state capacity and US power to affect these very, very large and globally integrated commodity markets. I'll give you two examples. One rate is permitting. The US government has made a concerted effort to shorten permitting timelines, designate priority projects, open up federal land for mining and minerals processing. But for a lot of these key projects, the problem's at the state level, not at the federal level. You need only look at Talon or Glencore's nickel projects in Minnesota, which have been held up for a very long time by state regulators. And the idea that the Democratic state regulators are going to go along with President Trump's deregulation of an industry that's had its challenges in the past in terms of environmental impact seems extremely unlikely. The second one is that abroad, the US has pretty limited power in reshoring these supply chains, not only because tariffs create complications in terms of the risk to a business and investment strategies that is centered around the United States, but also because China's actually locked up a lot of these markets already in terms of long-term political relationships, in terms of locking up the best supply, and in terms of processing know-how. The timeline to build a mine in the United States per S&P Global data is 29 years, second longest in the world behind Zambia. So we're going to have to look abroad, and we're going to be looking abroad to geographies, some of which we haven't had a meaningful presence for a long time. And we're going to be trying to do so in technologies where the US is a long way from global leadership. Take rare earth processing. That's been 95+% of that market's been in China for a very long time. I mean, we're a generation removed from Americans knowing how to operate these plants. And now the US is under a functional embargo from China. Makes it extremely difficult.
Especially when you then throw in, the uncertain trading partner, weakening sort of global soft power we've just been talking about. Why would you partner if actually you're such subject to such volatility, such noise? And again, it kind of, you've got this, I don't know, internal inconsistency, there's a better phrase for it, about sort of, his stated objective, but actually it's being undermined by other policies, other areas, other actions that essentially mean, again, you come back to this kind of, well, why bother doing anything for 4 years? Because we just don't know. Policies might reverse. Even if we were, and this has been relatively consistent under Biden as well, but what has significantly happened since the Trump administration is obviously that weakening of global soft power, less connectivity to these countries, and a perception of being a much less secure trading partner.
That's right. I would proffer cognitive dissonance as the right explanation rather than internal.
Holding two mutually exclusive things in your mind at one time. Yeah,
yes, exactly right. And one of the few things that seems relatively safe is if you have mineral projects, or you hold minerals either physically or in scrappable form, and you're in the United States, your economics look really pretty good, given the challenges of getting other supply off the ground, given the secular demand picture, now given the tariffs juicing your margins, and given the pressure from government to reshore these supply chains. For incumbents, either in trading terms or in investment terms, the picture looks very good, and that's something that's quite hard to see changing, even if Democrats take the White House in 2028, because there's a clear perception there that these minerals are so key to future industries, both in tech and in energy.
There has been, though, at the same time, DOGE, Department of Government Efficiency, it's not a department, I have to say that. There's also been a cutting of a lot of the administration infrastructure, i.e. people, that have been focused on this as well, right? So you're cutting a lot of US expertise in the US strategic critical minerals, sort of slices of the administration.
Right, exactly, and it creates a bit of a problem. And one of the things that has been a problem for the past two administrations in their support of these critical minerals projects is there isn't a single clearinghouse or policy agency that's fully tasked with these mining projects. There's interiors involved, energy's involved on the funding side through LPO. If you're doing something international, you want to go talk to the DFC, which is understate. It's a bit like Henry Kissinger's old line, who do I call when I want to call Europe? If you're a mining company, you don't actually know who to call when you want to call Washington. And that really complicates these strategic initiatives. The Trump administration getting rid of a significant portion of the federal workforce isn't going to help at all, given the complexity of the laws on the books, even if you have some very capable people as political appointees and cabinet secretaries.
Yeah, we had our mutual friend Peter Staley on talking about, and this was during the Biden administration, just that complexity of navigating federal, state, local government, in even if it were plain sailing kind of on the tariff side and all the rest of it, to actually just get through the regulatory hurdles to embark on one of these projects, right? It's just very, very challenging.
Exceedingly difficult, and we haven't seen evidence yet in its very early days that those timelines are shortening or that the thicket has gotten smaller. I actually think with the introduction of new funding mechanisms and tariffs, you think of it in terms of Pete's famous spaghetti chart, that chart's going to grow rather than shrink in terms of the different linkages and agencies you need to be aware of, which is probably opposite to the effect the administration would like it to have.
The energy and resources sector is experiencing unprecedented change. To help companies navigate this world and capture its opportunities, HC Group launched Enco Insights in 2023. Enco has rapidly become the leading global expert network dedicated to energy and resources. Enco Insights leverages HC Group's 20 years of connections and dedication to the sector to give clients the expertise they need to take decisions fast. Connect with Enco's experts for anything from a 1-hour insight call to a longer-term consulting project at encoinsights.com.
And we are moving on to you noted there, the trading opportunities, and we're going to come to some of your higher level analysis, and obviously they know who to call if they want to get more insight about the opportunities around all of this disruption. But staying on cognitive dissonance, you then got this narrative that very clearly came out to me at the FT's Global Commodities Summit. Bill Reed of CCI spoke very lucidly on this and powerfully, is suddenly in this world, security becomes the overriding concern. And there is again sort of this challenge that you've got on the one hand a Trump administration and Elon Musk and Doge and so forth, absolutely anti-regulation that's built into Project 2025. But in a world where security trumps affordability, excuse the pun, then suddenly you're moving away from Milton Friedman, and you're suddenly getting into a very different world of government intervention, government ownership. This came up with Trafigura's Nurstar in Australia. Hey, look, if you want zinc smelting, and associated critical mineral smelting capability, you can't just, if it's just purely in the private hands, it's going to lead to being shut down because the economics don't work. But can you just, I guess, do a better job than me in setting up that sort of cognitive dissonance between those two points of view, and then particularly where we're seeing government intervention from the US already?
Happy to, Paul. And I think this is the logical end state of what we've seen over the past 4 or 5 years in metals markets, which is this broad Western narrative of critical minerals and undersupply in the long term, and the need for a vast expansion of mining and processing, all of which may be true. It doesn't matter very much to the CEO of Trafigura whether it's true if you have China flooding the market and low prices, especially in a world where some of these energy transition technologies are not growing quite as fast as we might have projected forward a few years back. So the response from industry broadly has been, okay, well, governments, you're telling us you want us to mine, and you want us to process, and you want us to do this ex-China, but we need you to make it worth our while. And for so many of these metals, from zinc to nickel to lithium, the economics haven't worked for since prices came down pretty sharply over the last couple of years. It's completely incompatible for governments to be requesting more supply when prices are at the low point of the cycle in historical terms, without providing any kind of price security here. And you see this in what different governments are trying to do. We're not at the stage where we are with say low carbon fuels, whereby you've got CFDs for delivered products, but there's talk of say a processing price floor in the US that would be made up by government for defense applications. The DFC, the International Development Finance Corporation, is probably the key actor in the US here. They're the ones tasked in the recent executive order with scaling processing in the United States. That's set to be reauthorized by Congress this coming year. For a bunch of technical reasons, it's difficult for them to do equity investment, so we'll see if that changes. But they're probably the central player in government funding. They've already done a number of infrastructure projects aimed at increasing American critical minerals supply. They partnered with Trafigura on the Lobito Corridor Railway. But it also wouldn't be a surprise to see the Department of Defense under the DLA, Defense Logistics Act, take some more significant roles in stockpiling, or what you might think of as shadow stockpiling, and simply buying a lot more of these key minerals than the military needs in the near term, simply to prop up these markets. Because without a price signal, the supply is going to go offline, and you're not going to make any inroads into the Chinese market share.
Suddenly you're in a world of much broader government distortions, because then you're going to have competing with Europe. I mean, these again are policies that have a habit of cascading, right?
Yes, and the era of deregulated global commodity markets is over in historical terms. Not just in minerals, but in oil, where the US government has some form of sanctions on 15% of the crude market between Russia, Iran, and Venezuela. In minerals, we're seeing tariffs create price dislocations. We're seeing large-scale government intervention in projects, not just from the US, but from China, from the European Union, and elsewhere. So the idea that has been dominant in the commodities industry over the last couple decades has been commodities are purely globalized. Commodity trading houses are these depoliticized international companies that are able to stay above the fray of geopolitics and don't need to worry too much about government intervention, those days are over. And it doesn't seem like they're coming back anytime soon.
It's also fair to say as well that the people within those companies, and obviously what HC Group has thrived off for the last 22 years of its existence, is that's also been a very mobile community, apolitical, in some ways ageographical, and have been moving around the world in as much free trade of people as those commodities themselves. And that too is the next logical step as you start to sort of have this ossification of markets through tariffs, through government intervention, through geopolitical competition. The next logical step is then services and then people, right?
Certainly. Well, if we look at say the fate of Western professional services in mainland China, you could see that being extended to commodity traders. Although I would say that the shelf life for commodity trading seems very, very long, given the returns to scale, given the difficulty, and given the way in which these traders contribute to economic security in both exporters and importers. I think the world is going to need commodity traders for a very long time, regardless of what happens with decoupling and with decarbonization. But the scale of or the scope of their global operations, I could say, could be significantly reduced if the world continues to fracture into these economic blocks.
Yeah, the only thing I'd say there is that absolutely, right, there's a big case to argue that they are sort of the shock absorbers or the grease of global commodity trade, the grease of sort of the economy, in terms of Daniel Yergin said that. But often they are, and this is as a result of being kind of, sort of apolitical over the last 30 years, often they are absent from the policy making decisions around some of these critical supply chains. Think about battery metals and so forth. They're not in the conversation. We think about that in European energy and so forth. And as they're not in those conversations or haven't been in those conversations, policies can get created that essentially are absent that the needs of a global commodities market, and suddenly you get big disruptions as well, right? So if they aren't engaging, suddenly you can have those distortions magnified because the global commodity trade itself starts to break down and can't be the shock absorber for those markets.
What we're seeing is that commodity traders today just need to be significantly more aware of what's happening globally and geopolitically than they have over the past few decades. There's certainly still immense scope for them to operate, but they need to be aware of what's happening in Washington, Brussels, and Beijing at the political level, when previously the focus was really what is the economics, what's happening in terms of the macro, how does this inform my balances? Now the question is not what do I plug into my supply and demand forecast. The question is, how do I think about tariffs? How do I think about sanctions? How do I think about government funding for projects that might not make sense otherwise, but have a very nice rate of return if I can tap into public pools of capital? So it's a different way of thinking about economies and about geographies.
Yeah. Okay, so and this is why you need to call Greenmantle, but to help understand and navigate that now global political environment, let's just, all of this sounds pretty bleak, to be honest with you. I'm kind of coming off this after, in our second hour, quite depressed about clear inflation and waning US global power and the likelihood of this being the prelude to a much more volatile and dangerous world in the next decade or sooner. Not to sound too sort of Cassandra-like, but all of this does create change, and that creates opportunity, especially for those organizations that can span globally. What, I guess, when you think about trading opportunities, and a significant portion of your clients are funds and and traders and so forth, obviously not giving away the secret sauce, but about what's going to work in the future. But what's worked so far in Trump 2.0?
It's a very good question, Paul, and I think it gives us a guide to the future, an imperfect guide, but a helpful one. If we think about what's worked as what you might call decoupling trades, European defense, gold, Korean shipbuilders, a world in which the trading system is fracturing, individual geographies are responsible for their own defense, and the role of the dollar as a global reserve currency and the stability of the dollar is more under threat than it has been for a long time. There's obviously a case for safe assets like gold, but these individual sectors that really benefit from economic security are very compelling.
And sorry, Korean shipbuilders, because obviously global trade is about to go down dramatically. Why would I invest in Korean shipbuilders?
Well, I think the question with the shipbuilders, right, is global trade volumes matter a lot here. Part of this is around the US putting fees on Chinese ships, which are a huge part of the market. So the logic being that non-Chinese shipbuilders, which are mostly in Japan and Korea today, will be needed to serve a much greater volume of trade from a market share perspective. But it's also, Paul, it's unclear that global trade volumes will shrink given all the barriers to reindustrialization that we've mentioned. It seems quite a bit more likely that global trade volumes will stay roughly similar. More industries will reroute to third countries and tariffs will get passed through to consumers than a significant reshoring of trade given the timeline mismatch and given the barriers to industrialization we've discussed. So if you were to bet on a significant shrinking of trade volumes in coming years, I'd probably take the other side of that bet. And then going forward from here, there are some big trends that are still unaffected by what's happening. If we look at the demographic shortages and the need for automation of labor and the role that AI is going to play in that is not affected by the trading system. The gas and AI story we touched on feels relatively immune from geopolitics, at least in meeting US demand. The decarbonization is still growing, but not nearly as fast, meaning we need many, many more critical minerals. In the American context, we need many more of them to be mined and processed in North America. And from the perspective of commodity traders, a fracturing world with arbitrages opening up around the world between what were previously linked, liquid and relatively functional markets is in some ways a commodities trader's dream. They just have to take the right side of the geopolitical trade and be confident in their view. If you had predicted, say, the copper tariffs coming into play, you'd be sitting on a very nice gain without having to worry about fundamentals. The same is true as these energy markets fracture. The less liquid and the smaller these markets get in their scope, the greater opportunities open up for someone who's willing to confront those market inefficiencies.
Which is quite a different skill set in some ways. And to be fair, we have been seeing this transition. You've built up a capability ultimately in supply and demand over the last 30 years, right? And you've acquired assets that give you a better insight and view into that, through the flows, etc., etc. Actually, what you're talking about there is if you had much more effective intelligence gathering capabilities, and we are definitely seeing this, then that's your key now to being able to navigate these markets much more so than eventually your supply and demand will out or reroute. But actually it's that intelligence piece, it's that connectivity to governments, policymakers, to influence and so forth that now gets you that edge in some ways, obviously staying on the right side of legalities and so forth. But it's that bit that actually is a capability that they haven't needed to have.
That's exactly right, Paul. As the saying goes, you might not be interested in politics, but sometimes the politics is interested in you. And we're moving to a world where understanding that with high quality intelligence is going to be a crucial part of any operator in the commodity industry going forward.
There's also, as governments become increasingly involved, it's kind of careful what you wish for.
Right, and like you said, I was a little surprised by the Trafigura CEO calling for a nationalisation on Nistar, not just because of the economics. It makes some sense when you look at the performance, but the idea of a commodities trader going on stage at an industry summit and requesting government assistance or requesting a nationalisation of an asset from the government is really very hard to imagine at any point in it's in the post-Cold War period. So we are in the early stages of this kind of epochal shift, and we live in a new world in those terms.
Is there anything, so going back to that historical analogy, when you're sort of saying, okay, it's early Cold War, post Second World War Europe, where you had a wave of sweeping nationalizations, are we, because it feels like, the sort of 40-year period, and we've talked about this on the pod before, sort of Hayek, Friedman world is in the rearview mirror. I think what's coming loudly out of these two podcasts is that even if all this stuff gets walked back very quickly, and it's just maximalist bargaining, which I don't believe, the damage is in some ways done, and the world has changed, to quote Mark Carney, and the US is no longer going to be seen as the leader of global free trade and the economic order. Is there anything to be learned from looking at sort of that post-war period and actually that was a pretty rough time for for private commerce and tax regimes and all the rest of it?
Well, there certainly is, Paul, and you've pointed at the clear ones. What's a bit different about this time around is I think there is more mobility, there are more opportunities. I've been in London the past 2 days, and the scale of people leaving as non-dom regimes change and it becomes more possible to work from other places here is pretty remarkable. And people are scattering. They're going to Dubai, they're going to Miami, they're going to New York, they're going to Singapore. So we're in the very early innings of that kind of Cold War fracturing, if you think that's the case, and I do. But there are many, many more non-aligned states today than there would have been in the 50s and 60s, and they're much more powerful. If you look at the role of Brazil or India or Saudi Arabia, for instance, in what I think of as Cold War One compared to Cold War Two, you also have a slightly different balance of power between the US and China, in that you have one is the clear leader in manufacturing and minerals, the other is the clear leader in energy, technology, and likely from a military perspective.
We'll leave it there, although I think everyone can probably see we can go on for a lot more. It's been fascinating. I'll put links to Greenmantle in the show notes should people wish to reach out. And Nick, hopefully we can have you on in a year's time and see where we are on these particular threads. But I think sort of the rubric of signal versus noise, and as one lens, but also actually just some of the complexity and that sort of cognitive dissonance, which is probably the name of part 2, means it's a really challenging world to navigate. It probably means different skill sets in your organization, but there are certainly opportunities for that nimble global commodities world, as long as they don't make too many Faustian bargains.
Quite right, Paul. Hopefully I'll be on in a year and all of my gloomy predictions have proven wrong for the world, if not for me.
Good stuff. Okay, well, thanks, Nick. Thank you for listening. To find out more about HC Group, our global offices, and our expertise in search within the commodities sector, please visit www.hcgroup.global.